Hey, it's Van, the mortgage man. In this segment, I want to talk about how to determine your budget in buying a home. So the first place I start when talking to folks about their budget is you know your budget better than anybody else will. So lenders do have guidelines. Lenders have sort of rules on how much debt somebody can take on with their mortgage, etc. But you know your budget better than a lender will. You know what you like to spend your money on, and you might also have sources of income that a lender doesn't see. So we always start with, what do you feel comfortable with? What sort of level of monthly payment, results in you feeling comfortable and secure and having money left over for the things that you value, okay? So always start with a monthly payment that you feel comfortable with. Same thing with the amount of cash that you're going to be putting towards your transaction. You should obviously have some money left over whenever possible. You should use enough cash to get you as low of a loan amount as possible, but still have money left over for rainy day expenses as well as moving, etc. Okay? So now, what does a lender look at? Lender is going to be looking at something called a debt ratio. Okay? Lender is going to look at your monthly obligations as shown on your credit report, as well as your new proposed mortgage payment. And they're gonna want those monthly expenses to be a certain percent, typically under 50% or 45% of your gross monthly income. Again, that's just the standard. It doesn't mean that's the right thing for you. But in general, lenders find that that is a level that provides the buyers enough free cash flow to be able to live and to do the things they want to do and never fall behind on their mortgage payment. But key thing, again, is think about what works for you. What are you comfortable with? What have you done before? Now, when buying a house, you're paying a mortgage. It's a little different than paying rent, okay? So you don't want to compare exactly mortgage payment to your rent. If you're paying $2,000 per month in rent, a mortgage payment might turn out to be a little bit higher for you for the same type of property or a little bit bigger of a property, okay? Why is that? Because a good portion of what you're paying on the mortgage is building equity in your home. Okay, that is basically like putting money into a retirement account. Your home is your retirement account. You're building wealth by putting money into that home and creating equity in your home. So if it means taking on a little bit of higher payment to do that, it may make sense. Again, talk to your lender, figure out what's comfortable for you, and we'll work together to figure out the right solutions in your case. Thanks again for listening. Reach out with any questions.